Hi, okay, it's Mike Elliott speaking. I did in fact make a mistake last time around, so I am retaping the last class, and hopefully this works. So we're in chapter two, cash flow. Remember what we're trying to do, or the essence of what we're trying to get down to is how do we value things? From our previous conversation about time value of money, we're starting to get the feel that there is a way to value things. And one of those ways is if I know that we have a series of cash flows coming my way over the course of the next number of years, how do we figure out what they're worth today? And then if we have another bullet or a one-time payment coming in the far end as well, what's that worth? And if we can answer those two questions, we've just figured out what a bond's worth, because that's all a bond is. Um, if we can figure out what bonds are worth, then we can certainly figure out what companies are worth, and that's what we're trying to get to today. So we're going to look at cash flow, particularly how do we strip out cash flow? How do we figure out what's involved and what's not involved in cash flow? And how do we make something worthwhile out of an annual report that we can pull information out of and understand exactly what we're getting. So it's very, very granular. So we're going to start off today. We have our land acknowledgement. We are on the land stewarded by the Anishinaabe, Haudenosaunee, and Wendat nations. We acknowledge Treaty 13 signed with the Mississaugas, the Credit First Nation, the Williams Treaty signed with multiple Mississaugas and Chippewa First Nations. We are looking after land. It is our responsibility to make sure it's in good shape when we give it back. So, what are we going to talk about today? We're going to talk about the various statements, the balance sheet, the income statement, talk about taxes, talk about net working capital, cash flow for a firm, accounting statement of the cash flows, and cash flow management statement. What we're really trying to figure out now, when we look at cash flow, what's real cash and what's just kind of ersatz cash or uh, cash-like impacts on the income statement that we have to recorrect for when we look at what a cash flow is actually worth. So we have a look at talk about um, cases where things have gone wrong in accounting. In 2023, Disney brought forward the movie Crater. It was on Disney Plus and Hulu, and in fact, it pulled back a bunch of other content as well. Ended up writing down about $1.8 billion. End of the earth? Absolutely not. Disney is a massive company; they'll be fine. But it shows you that even the smartest people and people with the best intentions of all sometimes get it wrong. It's not perfect. In 2024, in January, Verizon wrote off $5.8 billion due to declining wireline business. Verizon had made a big pitch to lined long distance, and the industry moved past it, unfortunately. And Verizon was stuck with all this kind of old technology that wasn't producing anymore, so they wrote it down. Orsted's a Danish company that was investing very heavily in wind projects. Um, Two wind projects were canceled in New Jersey. I'm not going to tell you who canceled them, but you know what it is, what it is. The Danish company wrote down $4 billion because of it. Now, the question is, does this mean the shareholders involved in the companies lost money? And the answer is probably not. Some of the reasons are were they actual hits to profit? Or were they writing down sales that were expected that never came? Or had the shareholders already built in an expectation that perhaps these things weren't going to be profitable? Because expectations actually drive markets. And when you think about when we're looking at economic releases in markets-based businesses, what's the expected number that comes out? Well, the reality is this has been front played for weeks ahead of time. Uh, Everybody knows what is expected. And if a result comes in as expected, it has no impact. It's already been built in. It's when you get results that are not expected that start to have impacts. So in these cases, had the shareholders lost money? Probably not. So let's have a look now. We're going to talk about the balance sheet, the income statement, the cash flow statement predominantly today. You guys have all gone through BAB 140. Some of you have been through BAB 240. Looking at financial statements is not new to you. So we're going to kind of move through this relatively quickly, just so we can get to the meat at the end. So the balance sheet, what is it? The balance sheet is a snapshot of the firm's accounting value at a certain period in time. It says it right at the top here. U.S. Composite Corporation balance sheet 2024. I just want to make sure that we're actually seeing what I'm telling you we're seeing. I don't want to do this again. Just give me a sec here. Yes, we are. Okay, good. So it's a snapshot in time, and it tells you very clearly at the top, U.S. Composite Corporation balance sheet for the years 2024 and 2025. Year end, it should actually say December 31st, 2024 and 2025, to be perfectly clear. But there's two sides to all the balance sheets. On the left-hand side, we have the asset side. What is the value of the firm? What are the assets? What are the strong things that we can convert into cash if we have to? Things that power and add value to the firm. On the right side is liabilities and equity. By definition, the left side has to equal the right side. Assets have to equal the combination of liabilities and equity. Just by definition, it has to happen. How do we list things? On the asset side, we have to ask ourselves, if we have a fire sale and we have to liquidate everything into cash, what do we do first? That's cash and equivalents. And then we're going to start to order things on the balance sheet and assets in terms of things that take longer are going to go further down the balance sheet. That gets us through current assets, which are usually less than a year. And then we move into fixed assets. And fixed assets, generally speaking, are the hard assets that we have no interest in ever, or no interest, no intention of ever selling to our clients. This is investments we've made in our company not to sell. So we think of property, plant, and equipment. We think of intangibles. And intangibles, we think trademarks and stuff like that, right? How are the liabilities listed? In order of when they have to be paid. So we're going to go current liabilities. In this case, we have accounts payable. Then we're going to go longer term liabilities, deferred taxes, longer term debt, stuff like that. And that covers all the debt side. And then we move into equity. And the equity is the piece of the company that investors own, the residual, what's left. We have three concerns, generally speaking, when we look at the balance sheet. We want to look at liquidity. We want to look at the balance between debt and equity. And then we want to talk about value versus cost. So liquidity. What is liquidity? The ease and quickness with which assets can be converted into cash. We're talking specifically now current assets. Usually within a year. And there might be some notes involved, but usually it's within a year. On the right here, I've got a simple, what's the most liquid? Cash, CDs, bank accounts, treasuries, etc. Stuff that you can sell immediately. Semi-liquid, stocks, particularly less liquid stocks, because you have to find a market for them. Mutual funds, bonds, foreign currencies. And then the least liquid, real estate, jewelry, precious metals, art, etc., etc. Generally speaking, this is the way we're going to look at a balance sheet now. What are accounts receivable? Accounts receivable say that we have already exchanged the economic activity that's going to generate a sale or service or something like that, and we're waiting for the client to finish the contract by paying us. That's an accounts receivable. Inventory is the stuff that we have to hold in order to create or hold in order to sell. If we're in manufacturing, there's going to be types of inventories. We're going to have raw material inventory that we're waiting to convert into stuff. We're going to have work in process inventory that's kind of sitting on the factory tables waiting to be completed. And then we're going to have finished goods inventory, because the last thing you want to be as a salesperson is to have nothing to sell. So we have to make sure that we have stuff ready to sell. So all along the way, we're going to carry these three types of inventory, and they have value, right? And then we talk about fixed assets as the least liquid of the assets. The tangible assets, the ones you can reach out and touch, the ones that are real. Property, plant, equipment. We know them. We paid for them. We own them. We can see them. Intangibles are a little more difficult. There's no physical presence, but they have value, trademarks, patents, stuff like that, right? Goodwill. What are trademarks worth? I went through this when I was not taping, so I apologize, but we looked up Apple. And what's the Apple trademark worth? Hundreds of millions of dollars. Just the trademark. How do you account for that? You have to because it exists. It's money. It's worth stuff. Can you sell it? Kind of hard. But it exists. And then when we look at liquidity, what we're trying to determine is, are we going to be around? Are we going to make it through a period of financial distress? If we have to liquidate all of our short-term assets, our current assets, do we have enough money left over to pay our short-term liabilities or our current liabilities? If the answer is yes, we can sort of wipe the sweat off our heads and say, good. If the answer is no, we can have a long day. So liquidity. Debt versus equity. How is a company funded? And it changes. It's not the same for any company. It's not the same for a company through its life cycle. Generally speaking, if I have a new startup company and I've got the greatest product in the world I'm trying to sell, I will not get loans for that because I have no history. Nobody knows exactly what the appetite is for the product I want to sell. So I'm likely to have to fund myself in equity or borrowing from family, borrowing from friends, but I'm not borrowing from banks. I know that because banks aren't going to lend to me. So what we try to do is we try to figure out the mixture between liabilities and equity to see where the company is in its life cycle and see if it makes sense. Are we effectively raising money the way we should? Mostly because borrowing money is probably cheaper, especially if we have the track record to back it up, and we're not diluting ownership in the company. Types of liabilities. We can have bank debt, bonds. Now, bonds are interesting because bondholders have the first claim on the firm's assets. If we run into financial distress, the bondholders are the first ones at the door. Then we have banks, and then everybody else kind of lines up afterwards. And what we have with equity is a residual asset. This is what's left. After we've gone through everything else and liquidate anything else, if there's anything left on the table, that gets given to the shareholders. However, the shareholders also get to participate in the cash flows of the operation through dividends, right? Or retained earnings. So debt versus equity, we're very interested in that. And value versus cost. Where do we carry stuff? Think about a painting. As I said last time, and you've said condolences, so I appreciate that. Thank you very much. But I'm going through my father's assets, and one of the things he has is a painting that was purchased in 1950. What's the painting worth? Well, I know what it was purchased for. I don't know what it's worth to sell until I actually sell it. I can get an idea for it. I can get a market idea for it. But until we actually line up a buyer for a seller, we don't know exactly what it's worth. So when we look at stuff in our books and we look at accounting value is book value, where we carry it, where it was bought. Is there also going to be some sort of accumulated additional worth to market value? Absolutely. And we can look at that somewhere else too. But in our case, for accounting value, we are looking at the carrying value or the book value of what we're holding. And GAAP says that's what we have to do. And we were asked last time, what about Canada? We're looking at a lot of US accounting, but what about Canada? Well, Canada tends to follow the US very closely. So our IFRS tends to mesh very, very closely with GAAP. And in fact, we are seeing a synchronizing of GAAP and IFRS that's likely to continue as long as the US doesn't go off the rails. And I have to throw that caveat in because it's becoming not likely, but it's becoming less not likely. And what's market value? Market value is when you finally have a buyer and a seller lined up, and they agree on a price, that's market value. We can estimate what market value is, but until you actually pull the trigger, you have no idea. Now, what's the difference between the two? Well, if I'm a banker, I'm concentrating on lending you money. If I'm lending you money, I want it back. And I want you to pay me for it, but mostly I want my money back. So bankers are concerned with liquidity and working capital. If something bad happens, are you going to pay me my money back? Investors um, are looking at the value of the firm, not necessarily the cost of the firm. Um, all that information is not necessarily in the balance sheet either. We're going to have to pull value out of different places. Cash flows, right? What's the net present value of these cash flows? What's the income statement look like? Where are we generating that income? Do we have taxes? Can we shelter those taxes somehow? So there is value that we can find, but we have to look for it a little bit more closely. And then a note about globalization. It's real. It's not going away. And as much as some people want to turn back the clock, you can try, but you can't put the genie back in the bottle. It's not happening. So globalization is here. As we get globalization, we get synchronization of accounting standards. It's a natural reaction. If I have operations across the world, I kind of want to be able to make sense out of all their different accounting patterns into one. And that's why we've seen the US more closely aligned to IFRS. IFRS is not moving to GAAP. GAAP's moving to IFRS. Let's be honest here, okay? But we are seeing them synchronize. And the question is, are they going to fully synchronize or not? I don't know, but that's definitely where we're heading. So an example, Cooney Corporation. We're looking at the balance sheet. We have fixed assets worth $700 and an appraised market value of $1,000. So we paid $700 for these assets. The market suggests they're worth $1,000. Our net working capital is on the books at $400. If we liquidate it, it's on the books at $600. So what's the company actually worth? Well, not an easy question. It's going to take us about 13 weeks to answer it. But this is the problem. This right here is the problem. We have gaps in what the value of the company is. I know what I'm holding it at. I know what the market says it should be at. But my equity is a problem because my book value of equity is 600. My market value of equity is 1100. What's it actually worth? So we're going to figure this out over the course of the next few weeks. And then the income statement. What does the income statement do? Well, the balance sheet is a photograph in time. On December 31st of this year, this is what the company looked like. Is it the same now? Probably not. But at that time, that's exactly what it was worth. The income statement, however, is a little bit different because what it says is between period A and period B, this is what happened this is how the firm made money. It's not a snapshot in time. It's like a video of the last period, whatever the period happens to be. In our case, it's a year. So what happened in the course of the last year? Well, in the course of last year, we had operating revenues of $2.26 million. Cost of goods was 1.17. We had some selling administration, some depreciation. We had operating income of 130, other income, et cetera, et cetera. And we follow all the way through until we can figure out what our pre-tax income, what our taxes are, current and deferred, and then we can figure out what our net income is. That's kind of what we're trying to get to, right? And then we have a net income. Some of that income is going to retained earnings, and some of that's going to be paid out in terms of dividends. We know this. It's fine. What are the sections in the income statement? Well, we're going to look at different pieces of the company as they contribute to our income. We're going to have operations. And operations refers to the regular business of our company. If our business is selling chairs, this is what we do when we sell chairs. This is our operating income. From operating income, we're going to have earnings before income and taxes, EBIT, a very important tax part. We're also going to have to think about what's actual cash and what's acting like cash in our income statement here. Because if it's acting like cash and it's not really using up cash, we got to put it back in when we do our calculations. And then we think about non-operating income. Where do we get income from that's not a result of our operations? We're going to break this down further in a minute, um, but it includes financing costs, investment costs, stuff like that. So where do we get our income from that's got nothing to do with our main source of business? So if we sold a business, we sold a building, if we sold something that raised money, not through the course of our operations. Um, eh, bi- 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 bi. Yeah. So we're going to keep an eye on three things: gap, the non-cash items, and time and costs. The non-cash items that we talked about. If they're not actually using up cash, we got to throw them back into the bucket. So we're going to look at this in a second. Gap, generally accepted accounting principles. There's a bunch of them. Uh, Business entity, monetary unit, time period, et cetera, et cetera, et cetera. It's a bunch of stuff that's involved in there. I'm not teaching gap because you guys you've studied gap for the last 3 years. Well, the key parts of gap, we're talking about accrual accounting. Revenue is recognized when the earnings process is virtually completed. When I do the economic activity that generates revenue or generates a sale, irrespective of whether or not the cash is traded hands, we are booking revenue. Um, we have unrealized appreciated income when we own stuff that we bought for my painting that we bought in 1950, and now it's 2025, 75 years later. There's going to be an unrealized appreciation in there. That's not included in this. We know it's there, but until we sell it, it doesn't matter. The matching principle says we're going to try as well as possible to have expenses match up with revenues. Have a revenue, was there an expense, match them. Good. And we're reporting income when it's accrued, not when the cash is moved. We don't care about cash anymore. Until a minute from now, when we really care about cash. But in accounting, it's funny because we talk about accrual accounting. Cash doesn't really matter, but cash matters a lot when you don't have any of it. So this is what we have to make sure we're when we start to talk about our liquidity positions. We care about cash at this point, right? Non-cash items. So we have stuff that doesn't appear on the income statement that does use up cash. And we have stuff that appears on the income statement that doesn't use up cash. Um, there's some non-cash items that expense against revenue but don't use cash. We know that. Depreciation, deferred taxes, stuff like that, right? Now, the deferred stuff we're not that worried about because according to theory, over time we're going to have accrued and deferred and paid and deferred and they're all going to even out eventually. They're going to be up some days, down some days, up some days, and they're going to even it. But remember, anything that's deferred is not a cash outflow. So we got to toss that back into the bucket as well. So what we're really trying to figure out is the expenses that we have. What are the cash expenses and the non-cash expenses? Because the non-cash expenses don't use up cash. We got to throw them back into the bucket. And those are depreciation, stock-based compensation. They're all on the right here. Amortization, stuff like that, right? So, yes, we can use it to our advantage because they are expenses that bring down income, so they bring down our taxes, but they do not use up cash. We have to bring that into consideration. And then time and cost. Um, what's the difference between the short run and the long run? And what's the difference in period costs and product costs? Once again, you guys have been through accounting. I'm not teaching this to you, but the short run, generally speaking, is an accounting period. In our case, we're going to assume it's a year, but it could be something different. It's not the same for all industries. There's going to be fixed costs in the short run. Rent doesn't change in the short run. However, in the long run, everything's variable because in the long run, everything changes. Rent's going to change year by year, et cetera, et cetera. So we have to consider the difference between the short run and the long run. And then the difference between period costs and product costs. The way I teach it to my 140 class and my 240 class is picture that we're making chairs. If something actually touches the chair, in the production process, it's a product cost. If it doesn't touch the chair, it's a period cost. Yes, we need it to run the company. No, we don't need to spend it to produce this chair. That's really the fundamental difference there. And taxes. Oh, taxes, we can't get rid of them, right? Death and taxes. Um, Generally speaking, taxes are going to be the largest cash outlay of any firm. Disney's EBIT was 4.77, taxes 1.38, tax rate 29%. Walmart, taxable income 21.8 billion, taxes 5.58, 26%. The I lost my brain. Sorry about that. Um, how much you actually pay in taxes is going to be a result of the tax code, not necessarily economic forces, political forces. Political forces dictate what the tax rate is going to be. How much does a politician want to pander for your vote? In 2017, Trump won, did the largest single tax cut in history, theoretically. Turned out not to be, but that doesn't matter. But what it is, it cut the corporation's tax rate to 21%. Is this fair? Hard to say. Fair and business don't really go together that often. But if you are not in a corporation, your tax rate is different than 21%. If you have a partnership or proprietorship or an LLC and you're not a corporation, then you've got a problem because you're being taxed at your personal income tax rate, because the income you derive from a partnership or proprietorship or an LLC is considered personal income tax. Is considered personal income. So it's going to face personal income tax rates, and they're substantially higher than 21%. So, is there a reason to incorporate? There's a bunch of reasons. The 21% is a big one. So, tax rates. Now, when we talk about tax rates, we need to consider that there's differences in what we call the average tax rate. Our guy over here on the right side, that our person that makes $125,000 in income, pays $23,000 in income tax. The average tax rate is $23,000 divided by 125,000. The marginal tax rate is what you pay on the next dollar you earn. And it's not the average tax rate. Because if we look at the table on the top right, we see that taxable income is calculated as from 0 to 11,600, 10%. From 11,600 to 47,150, 12%, etc. And the percentage applies to the next amount. And what do I mean by that? Well, from 0 to 11,600, we pay 10%, $1,160. From up to 4750, so the difference between 11,600 and 4750 is 35,500. We pay 12% on that. And then the difference between 100,525 and 4715. So this clobber piece in here is $53,000. We pay 22% on that. And then the last piece is the difference between 125,000 and the top of this bucket of 100,525. So it's around $24,000. On that $24,000, we pay 24%. 24% of $25,000 is about $5,085. So we have our buckets, and those buckets add up to $23,042, the total tax bill. The average rate will be the $23,042 over the 125. The marginal tax rate is 24% because that's the next dollar we earn. When we go to 126,000, we're still in this bucket and we're still paying 24%. That's our marginal tax rate. Once again, from before when I didn't do the recording, very good question. Why am I using U.S. tax rates and not Canadian tax rates? I've got an answer. Whether it's a good answer or not, I'll let you decide. It's a U.S. textbook. So I'm using what's in the textbook. Could I use Canadian tax rates? Sure, but they change every year. We also have federal and provincial taxes. So wherever you're sitting, you may have a different answer than the person that's sitting in a different classroom in a different city. So I'll stick with what's here because the concept is the same. We're still going to work with buckets. It's just in Canada, we're going to work with buckets in two different buckets that we kind of push together. We're going to have federal and provincial, and we push them together afterwards. So taxes. Oh, let me have a sec here while I'm doing this. I have compiled most of this stuff into a spreadsheet that is all already on Blackboard, and calculating the marginal tax rate is right here. So at 23,042.50 over 125 gives us a tax rate of 18.43%. All right, net working capital. So cash doesn't matter until cash really matters. Cash really matters when you don't have it, and that's called a liquidity problem. What we're looking here is at liquidity. Our current assets versus our current liabilities. Do we have more current assets than current liabilities? And if we liquidate the current assets, do we have enough to cover the current liabilities? That's the magic question. When we look from year to year, how does that position change? So in 2024, we had $707 million in current assets, 455 in current liabilities, or net working capital of 252 million. 2025, we had 761 and 490. Our net working capital went up to 271 million. So our net working capital is moving in the right direction and has changed by $19 million. This is a positive change in working capital. Now, the big problem with working capital is it's almost meaningless when you compare company against company. And what do I mean by that? If I look at this company here, and we've got $252 million in working capital, and I've got an asset base of $1 billion. That's pretty good. If I've got exactly the same working capital and I've got an asset base of $100 billion, is it as good? It's a meaningless comparison. And that's why we moved into ratios. We're not looking at ratios right now, but that's why we moved into ratios instead and said, what do the quick ratios and the acid test ratios look like? Because then we can get away from comparing 252 against 252 when the background means it's substantially different. So for the time being, for working capital, we're looking at, if we liquidate our current assets, can we pay our current liabilities? To get there, we have to figure out what is real. What's a real cash flow? The actual cash flows of the firm are the most important item we can extract from the financial statements and the hardest one to do because we have to kind of sort through the mishmash and gobbledygook to figure out what's real. Specifically, when we break down the cash flows, we're looking for where those cash flows come from. How do we generate that cash? We're going to have cash flow from operating activities. Our operating activities are what we do on a regular course of business. If we sell chairs, the money we make and spend on making chairs to sell, that's our operating activity. We also have cash flow to creditors, which are which is our investing activity. And then we have cash flow to investors, which is our financing activity. So we're trying to figure out what we do as we go through this exercise. We're going to try to pull apart those three sections of cash flows so we can come up with one combined section of cash flows near the end. And once again, I'm going to flip back and forth to this because there's a reason for it. You'll understand it in a half a second. So assets equals liabilities plus equity. That's the primary accounting function. We can use it for cash flows as well. Cash flows from operating activities are equal to cash flows to creditors plus cash flows to investors. And I thought my eyes were bad, but it's not my eyes. Okay. Now then, everything we do from here, I'm sorry, everything we do from here um, is going to be pushing back to this balance sheet and this income statement. And that balance sheet and that income statement are right here, balance sheet and income statement. So what do we have? We have cash and equivalents that went from 157 to 198, accounts receivable that went from 270 to 294, and inventory that went from 280 to 269. Current assets went from 707 to 761. What's our operating cash flow look like? Well, our earnings before interest and taxes. Interest before interest and taxes. Where are we here? Oh, bother. Earnings before interest and taxes, 159 million. 159 million. Our depreciation was 90, and our current taxes were 150. We're 15. We've got to add the depreciation back into the equation because it's not a use of cash. And our current taxes come out because they are a use of cash. So if we go to our financial statement here, we have our earning before interest and taxes of 115, 159. We have depreciation of 90 that we're going to put back in there. And we have taxes. Where did our taxes go? Oh, yes. Our taxes are going to be current 15 and deferred 9 for 24. So what we have to add back now, what we have to add back now, we're going to have our earnings from our EBIT. We add back the depreciation because we're not spending it. We're taking out the cash. So cash flow from operations is 234 million. From a capital spending perspective, this comes from the textbook, so you kind of have to read the text and get the subtext and the whole story here. We sold a subsidiary for $25 million. So sales of fixed assets, $25 million. We did acquire $198 million of fixed assets through the course of the year. So the difference between what we acquired, 198, and what we sold, 25, is capital spending of 173,000. This is 149 dollars of increase in property, plant, and equipment, and $24 increase in intangible assets. Doesn't matter much right now, but that's where it's from. And when we look at our balance sheet, we can pull these apart and figure it out where they all came from. So intangible assets we increased by 24. And that's our 24 right here. And property, plant, and equipment, 1274, 1423. Oh, we'll go net. Whoops. Lost. There we are. What can I do in here? Oh, it's up here. Sorry. It's 149. It's not in that. Yeah. So we increased property, plant, and equipment by 149, and we increased intangible assets by 24. And that's exactly what we're seeing right here. So we have capital spending of 173. And then additions to net working capital. In net working capital, we look at our current assets. We increased by 54, and our current liabilities we increased by 35. 54 minus 35 is 19. So we have increased our net working capital by 19. And if we increase our net working capital, it uses up cash, so minus 9. So cash flow of the firm was 234 from operations, out 173 for capital spending, out 19 to increase working capital. So we net added $42 million in cash flow. And then we have debt and equity below. Ah, let's pull all this apart now. Cash flow paid to creditors, and then cash flow to stockholders. And if we go back here, cash flow paid to creditors and cash flow paid to stockholders, and that's our $42 million right there. What do? We have interest of $49 million. We have interest of $49 million. We have retirement of debt of $73 million, and that's going to be retirement of debt. Oh, we're not seeing it on here. I'm sorry. Retirement of debt is 73 million. Total debt service is 122 million. Proceeds from long-term debt sales is 86 million. 471 to 458. And that gives us a total of $36 million in cash flow paid to creditors. To stockholders, we have dividends of 43 million. Dividends of 43 million. We're purchasing stock for 6. So cash to stockholders minus 49. And we have process from new stock of 43. So we have a total addition of 6 million in cash. Couple of observations. Operation flow is defined as EBITDA. So earnings before income, taxes, and depreciation is normally positive. Totally expect it to be positive. When we start to adjust for capital spending and working capital, these are frequently negative. So it's very possible for rapidly growing companies that have to spend on capital spending and increasing working capital to have negative cash flow. You can't have negative cash flow for very long, but you can have negative cash flow for a brief period of time. Now, net income isn't cash flow. We got to accept that. We have to know that. We have to believe that. Total cash flow, which was $42 million, is known as free cash flow. Not because it's free in any way, shape, or form, but because that's what's left over to pay creditors and shareholders. That's what's free to pay. So now we have to talk about the statement of accounting for cash flows. Because the statement of accounting for cash flows, we basically just created, but now we have to figure out why we created it the way we did. So we're going to explain how we changed it, how the accounting cash for the firm changes from year to year. Our accounting cash changed it says 41 million here. It's actually $42 million from 24 to 25. And how did that happen? Well, first we're going to figure out operating activities. What's the net income? What are non-cash charges? What are gains and losses? And what are any changes to working capital? Then we're going to look at investment activities. And what's an investment activity? Money that we invest in our company to grow and improve our company. Capital expenditures, acquisitions, purchases or sales of assets. And finally, we're going to look at financing activities. And the financing activities are, how do we fund our company? Do we borrow it? Do we raise money through equity? What do we do? So step one, we got to figure out what is the cash from our operating activities. We'll go back to our balance sheet and income statement here, which you can't see as well, but I got it on the spreadsheet here, and it's a bit easier to see. So cash flow, cash flow from operating activities. We've got our net income. We've got to add back depreciation because it's not a cash expense. We've got to add back deferred taxes because it's not a cash expense. And then we have to look at our change of working capital. So what's our net income? Our net income is 86 million. 86 million. We're going to add back deferred taxes, which is 9. We're going to add back depreciation, which is 90. So we're adding back 99 there. So we've added 9 and 99. Have we made any other changes? Well, our current assets, we saw go up by 54 million, and our current liabilities we saw go up by 35 million. This is broken down a little bit more because we had a change in cash equivalents and we had a change in accounts receivable and accounts and inventory. That doesn't matter that much because accounts receivable, we have a change of 24, which was an increase. Inventories, we pulled down by 11, and accounts payable, we increased by 35. Net, we added 86 from net income. We added back 90 from depreciation. We added back 9 from taxes. We took out our increase in accounts receivable. And we added back our decrease in inventory and our increase in accounts payable. Cash flow from operating activities is 207 million. Cool. Investment activities. What did we invest in the firm? Well, we acquired fixed assets of 198 million. We have sales of fixed assets of 25 million. So our net change is 173 million. Net change in assets is 173 million. We're going to have intangibles. You have to trust me on that one. It came out of the textbook. And then we say, okay, fine. Financing activities. What have we done to raise or use up money in the firm? Retirement of long-term debt. We bought back that debt. That used up $73 million. We issued new debt and generated $86 million. We paid out dividends that used up 43 million. We repurchased stock that used up 6, and then we issued more stock that generated 43. Through the course of all of this, we generated $7 million. What's this look like? Well, net income plus depreciation plus deferred taxes, less the addition to accounts receivable, plus the reduction in inventories, plus the increase in accounts payable gave us cash flows from operations of 270. Minus 173 was our cash flow from investing. And then we have retirement of debt of 73, proceeds from debt sales of 86. We paid out $43 million in dividends, repurchased stock for 6, raised $43 million from new stocks, so that's 7 million. Our net change in cash flows was plus 207 from operations, minus 173 from investing, and plus 7 from financing, I'm sorry, to a net cash change in cash flows of 41 million. Beautiful. That's our statement of accounting statement of changing cash flows. Why is cash flow management important? Well, it should be hard to manipulate the outcome of a cash flow statement. It should be. It shouldn't be something that we can spin into a narrative. But it's not impossible. If we monkey with how things go in and out of the cash flow statement and how we record two sides of transactions, then we can play around with the cash flow statement. I'm not telling you to because it's illegal. But Tyco did this by booking cash flows both as from transactions as both operating and financing activities. Is it correct? Absolutely not. Dynegy booked some round trades where they bought and sold exactly the same asset. Did it result in a profit? No. But what it did is they moved cash from the cash flow statement from the sales to the investment statement when they bought it back. Once again, legal, no, but it took a while to figure this one out. And then Adelphia capitalized all the labor they used for installing cable. Why does that sound dodgy? Because it is. Because when you capitalize labor, you're calling it a fixed expense. Labor, quite frankly, is not a fixed expense. All of these were attempts to boost cash flows by changing the headings. Was it fair? Was it right? No. And it was caught 100%. It will eventually get caught. Nortel did the same thing. It eventually got caught. Enron did the same thing. And we talked about Enron before. It eventually got caught. So we don't want to go down those roads. Summary and conclusion. Cash flows generated by firm and paid to creditors and shareholders. We cash flow from operations, from changes to fixed assets, how we invest in our company, and from changes to working capital. It's not really that difficult, but we got to get it right. Don't confuse cash flows with changes in working capital or net income. And this is where we started our break. And this is where I started taping last time. So I actually have this tape from here on. So now we're going to have two tapes. Good luck. Thank you very much for listening again.